Well, hello and welcome to another edition of MEMA Supplier Insights. I'm Mike Jackson. I have the pleasure of serving as Executive Director of Strategy and Research at MEMA. And I'm really pleased to be able to welcome Marcus Holzer here, a partner in the Risk and Financial Advisory at Deloitte. Marcus, great to have you with me here today.
It's my pleasure, Mike. Good to be with you.
Hey, so we're really excited to be able to talk about the third quarter Automotive Supplier Barometer, focused on capital markets and innovation. Let's just jump right in here with the supplier outlook. As we typically do, we cover our the barometer result. We ask our members, well, how is your 12-month outlook and how has it changed over the past 3 months? Have you become more optimistic, more pessimistic? Ultimately, we came in here for the third quarter at 49. So 49, just marginally negative, 50 being neutral. But that follows a handful of quarters where suppliers were a bit more pessimistic. And so I think, right now, arguably, there's reason for some optimism, and yet it's constrained. And so due to a range of risks. And so I think we'll move forward one more here, because I think the elephant in the room really comes back to the UAW labor contract talks. That the potential for strike is a real constraint for our members, and so this really kind of underscores the level of risk, the level of concern. So we know the industry has been constrained here, certainly post-COVID, semiconductor, a range of supply chain risks, but labor availability constraint. We're on pace to gain about 1.4 million units of production volume here in North America this year. And so the strike impact offers a pretty significant headwind. And then coupled with, I think, the economy, the weakness in the U.S. economy, it remains a factor, but I think we've probably overperformed a little bit here more recently. Any thoughts here on this, Mark?
Yeah, no, I think your read is accurate, Mike, and consistent with what we're seeing and feeling in the market. Certainly, the economy's done better than I think most have expected. It looks like the risk of a recession is by and large passing. Unemployment is at record lows. Interest rates are at, I don't want to say record highs, but certainly highs in the context of the last 10 or 15 years. And I do think the strike is a significant event, or the potential for a strike is a significant event that we're certainly watching across our client base. And I think there's a number of outcomes aside from a potential strike that could have some impact. The UAW demands for labor and benefits are significant, certainly significant to what exists now. So even without a strike, a generous labor agreement could have ripple through effects through the supplier community. Not all supplier plants are unionized, but some numbers certainly are. And even if they're not, I think the impact of that as a benchmark labor rate could have some impact. There's been rumors that some of the OEMs have been building inventory in advance of a strike. So there could be some production pullback afterwards if there's no production disruption as a result. And then obviously, if there is a strike and some number of assembly plants are shut down across the three OEMs, there's obviously an immediate impact on suppliers as they're no longer shipping components. So I think that that dynamic and how these negotiations play out over the next 2 to 4 weeks will be really, really interesting to watch. And I do think, just aside from all that, particularly in the smaller suppliers, although this is something we're hearing with our supplier clients of all sizes, labor availability, turnover, the need to rely on temps, churn, etc. It's a real challenge. It's a challenge in the U.S. and actually it's a challenge in other markets. So So I'm not at all surprised to see that at the top of the list. And then also just the interest rate change, dramatic over the course of the last 12 months. And I think when you couple high interest rates with, generally speaking, higher inventory levels that suppliers have been carrying. We kind of joke, suppliers have moved from just in time to just in case because of all the supply chain challenges of the last 2 to 3 years. When you put those two together, I think you've got a little bit more stress on supplier balance sheets and cash flows as a result. So again, not at all surprised to see that at the top of the list.
Yeah, great points all the way around. And I would echo, I mean, the piece there on labor, it's availability is one, but it's also the ability then to retain, right? Because, and then this is one of the real concerns I know that our members, it's okay, so should something happen, how to make sure that we can, get folks to come back, and because it's been very difficult. That's been a very difficult process here, in a post-COVID, post-semiconductor supply chain, environment. And so this is a key point. Let's keep moving on here. And so to your point, though, you also mentioned, just a read of a range of indicators. And so not a big surprise if we look at, so our members, how is your company, how have these indicators and what changes have you experienced here over the following time frame? So a year relative to a month, here, not a big surprise, 50 being neutral. New orders positive, production positive, inventories neutral, costs, up pretty significantly. Well, on a 1 month basis, things are a bit more, kind of, steady, and yet, customer inventories are actually, meaningfully higher, and costs are also, high as well. And so I think your comment about labor is another, is partially reflected here as well. Any additional thoughts? I mean, it kind of ties in pretty nicely with your previous comments.
Yeah, no, and just to maybe a couple things, even though inflation seems to be moderating, I mean, it's moderating off an increase. So costs have gone up.
Yes.
They've stopped increasing, but they're not necessarily decreasing. So I think if you're a supplier, you're feeling the impact of increasing prices immediately. You're getting relief from your customers on a delay. So I think there's still a bit of that needs to work through the system. And then just on the comment around customer inventories, I guess it remains to be seen how much will revert to Auto 1.0 in terms of the push versus pull model at the OEM level. During the pandemic, dealer lots were empty. And I think anyone that's driven by a dealership recently can obviously see they're not empty anymore and they're full, and incentives are starting to come back. And we're kind of moving into that push model again, the old model. So, that constrains the OEMs at the top line, because now money on the hood is necessary to move units. So I think that puts some tension back against the suppliers going after increased costs on the bottom line. So it'll be interesting to see how those two dynamics work out over time.
No, well put. Let's we'll keep moving here, and this is, I think, an important one. I mean, we talked about the economy, and again, results, overperforming, if you will, relative to what initial expectations here were at the start of the year. For the most part, there was an expectation that we'd, potentially enter into a mild recession here, come the third and fourth quarter of this year, and so ultimately that's been pushed. And so, but interestingly enough, our members indicate, well, they're kind of torn, almost 50-50, the median there. And yet I think the positive here is that the vast majority of our members indicate that they feel pretty well prepared, at least somewhat prepared, for a recession. And I think, some of these elements here kind of tie into the potential risks here for some type of a work stoppage. I think it's interesting that, look, obviously, lessons learned in COVID actually have helped prepare and maybe, kind of better equip the suppliers to be a bit more resilient, to be a bit more agile and to kind of anticipate, some of the shocks, the turbulence that we can see across the industry. And so I guess maybe any comments on the economy as a whole or the outlook here?
Yeah, I think your first slide, Mike, was a good indicator of the industry's resilience. Roller coaster on the supplier confidence interval, and just crisis after crisis that the industry has successfully dealt with. And certainly, we're both old enough to remember 08, 09 and in that period, and what happened in terms of supplier bankruptcies and whatnot. I don't think we're anywhere near that now. And I'm not surprised to see the confidence across the supply base, small and large, in terms of being able to deal with this. I mean, I still think we're at an inflection point around potential existential change with the shift to EVs over time, and maybe we'll talk about that in a bit and what that means longer term. So I still think there's a fair bit of uncertainty on the horizon, but we feel reasonably confident about the economy as a whole and volumes holding up. Again, I think there's stresses on the system, but nothing we haven't seen before.
Well, one comment that I would just kind of be interested in hearing your opinion. I mean, we have some concerns just based on the fact that we know that supplier sub-tier distress has been very real, and so the concern is could this push some folks into a perilous state, right? And so that's one thing that we're also very mindful of, very concerned about. It certainly isn't the kind of the baseline assumption, but obviously depending on duration of any potential work stoppage, that could be a very big concern.
Yeah, no, absolutely. And I mean, as when the assembly plants shut down, the suppliers don't ship and cash doesn't come in. I mean, it does, but there's an immediate, an immediate impact. And with labor availability a challenge, maintaining that workforce for the resumption of production and ordinary business, it becomes expensive. So, I mean, there's certainly a risk to the system, much like when COVID came through in spring of 2020 and everybody shut down. It's the same type of shock to the system potentially. So it is certainly something that we're monitoring and we're having discussions with our clients on.
Well, listen, Mark, you've been a wealth of knowledge. Really appreciate your insights here. Everyone, thank you so much for joining us here for our third quarter Automotive Supplier Barometer. Stay tuned. Marcus, thank you again. Appreciate you and Deloitte and your partnership.
My pleasure, Mike. Thank you.
All right. Well, look for us next time here on MEMA Supplier Insights. Thank you and take care.